All right, I need you to lock in for the next few minutes. What I'm about to walk you through is not a prediction, it is not a theory, and it is not a headline from next month that you should be preparing for. This is something that started happening in a 48-hour window that most people completely missed. And if you understand what it signals, your entire relationship with your bank account changes from this moment forward. Here is the specific event. Banks across the United States currently cap daily ATM withdrawals between $300 and $1,000 for standard account holders. Most people hear that number and think nothing of it. They assume it is a technical limit, a fraud prevention measure, a routine banking policy. And in normal times, that is exactly what it is. But here is what changes everything. That cap is not static, it is discretionary. And the threshold at which a bank decides to tighten it, lower it, or activate emergency restrictions on your access to your own money is not governed by your account balance. It is governed by the bank's liquidity position. And right now, that liquidity position is being held together by mechanisms that expired, were wound down quietly, and have not been replaced. On March 11, 2025, the Federal Reserve's Bank Term Funding Program, the emergency backstop that was created in a single weekend in March 2023 after Silicon Valley Bank collapsed, formally closed. Every loan it had issued matured. Every outstanding balance was repaid. And the safety net that had been sitting quietly under hundreds of banks with unrealized securities losses and heavy concentrations of uninsured deposits was officially removed. No press conference, no primetime segment, no panel of analysts telling you that the training wheels just came off. The program simply ended and the banking system moved forward with one fewer liquidity cushion than it had the day before. That is not speculation. That is documented Federal Reserve policy. And it is the first data point in a sequence that tells a very specific story. I have spent time studying how liquidity crises actually develop. Not how they are described after the fact in academic papers or postmortems, but how they actually build, how the early signals look, and how the institutions inside the system respond before the public has any idea what is happening. And what I can tell you with confidence is this: you do not see a bank run by watching depositors line up outside a branch. You see it first in balance sheet mechanics, in the movement of money between institutions, and in the quiet tightening of access policies that do not require any announcement or explanation. The ATM cap is not the crisis. The ATM cap is the instrument panel. And right now, several gauges are reading in ranges I have not seen aligned this way since 2023, and before that, 2008. So here's what this video is going to do. I am going to walk you through exactly how we arrived at this moment. I am going to show you the specific mechanics that connect unrealized bank losses, uninsured deposit risk, and emergency liquidity facilities in a chain that makes what happened to Silicon Valley Bank not an isolated incident, but a template for what becomes possible when the backstop is gone. And then I'm going to show you what that means for your money today, not in some hypothetical future crisis, but in the environment that exists right now on the other side of a program that quietly shut its doors. By the end of this, you will understand why your bank balance is not the number you think it is, and you will have a clear framework for what to do about it before the window gets smaller. Before I go any further, I need to establish one foundational concept that will make everything else in this video click into place. That concept is the difference between a solvency crisis and a liquidity crisis. Most people hear bank failure and assume the bank ran out of money. That is not how it works. A bank can be technically solvent, meaning its assets are worth more than its liabilities on paper, and still fail within 72 hours if it runs out of liquid cash to meet withdrawal demands. That is what a liquidity crisis is. You have value, but you cannot access it fast enough, and that gap between value on paper and cash in hand is the exact gap that the Bank Term Funding Program was designed to bridge. Here's the mechanism with precision. When interest rates were near zero between 2020 and 2022, banks did what banks are designed to do. They took in enormous volumes of deposits that flooded in during the COVID stimulus period, and they deployed those deposits into longer duration assets. U.S. Treasuries, agency mortgage-backed securities, fixed-rate instruments that paid higher yields than cash and were considered essentially risk-free from a credit standpoint. This is called asset-liability mismatch. Your liabilities, the deposits you owe to customers, are short-term and callable on demand. Your assets are locked in long-duration instruments with fixed rates. In a stable rate environment, this works. In a rising rate environment, it becomes a slow-motion problem that turns into a fast-motion crisis the moment depositors decide to leave. When the Federal Reserve raised interest rates 525 basis points between March 2022 and July 2023, the most aggressive tightening cycle in 4 decades, the market value of those long-duration assets collapsed. A bond that pays 1.5% in a world where the risk-free rate is 5.5% is worth significantly less than face value. Banks were sitting on hundreds of billions of dollars in unrealized losses, losses that did not show up in their reported earnings, because accounting rules allowed them to hold these assets at cost rather than market value as long as the banks did not sell them. The losses were real, they were just invisible, until they were not. Silicon Valley Bank had roughly $91 billion in a held-to-maturity securities portfolio when it failed in March 2023. When depositors began withdrawing funds in late 2022 and early 2023, partly driven by the venture capital funding drought, forcing startups to drain their operating accounts, SVB was forced to sell securities into a market where they were worth less than book value. On March 8, 2023, the bank announced a $1.8 billion loss on that securities sale. Within 48 hours, $42 billion in deposit withdrawal requests had been submitted. The bank was closed on March 10th. That is how fast a liquidity crisis moves in the digital age, not in weeks or months, in hours. What the Federal Reserve did in response was create the Bank Term Funding Program on March 12, 2023. The mechanics of that program are important to understand because they tell you exactly what problem it was solving. The BTFP allowed banks to pledge their underwater securities as collateral and borrow against them at face value, not market value. If you had a treasury bond sitting on your books at $100 but the market price had fallen to $80 because of rate increases, you could borrow $100 against it, not $80. This was a direct subsidy. It papered over the unrealized losses by giving banks a way to access liquidity without being forced to realize those losses through sales. More than 400 financial institutions used that facility. It peaked at roughly $165 billion in outstanding loans, and on March 11, 2025, that program formally closed. The question you need to sit with is simple. The conditions that made the BTFP necessary, rate-induced unrealized losses, uninsured deposit concentration, asset-liability mismatch, were those conditions fully resolved by March 2025? Because if they were not, the program closed on a problem that still exists. And the answer, based on Federal Reserve data through late 2025, is that the liquidity stress ratio at U.S. banks, which measures the mismatch between runnable liabilities and liquid assets, remained above pre-pandemic levels. The ratio had declined from its 2022 peak, but it had not normalized. The underlying exposure did not disappear. The backstop did. Now let me take you back further, because this is not the first time this sequence has played out. And understanding the pattern is what separates someone who acts from someone who waits. Go back to 1930. The stock market crash of October 1929 gets most of the historical attention. But the banking crisis that defined the Great Depression did not start with the crash. It started with what came after. Between 1930 and 1933, more than 9,000 banks failed in the United States. And the mechanism was almost identical to what I just described, adapted for the financial technology of that era. Banks had taken in deposits and deployed them into assets, particularly real estate loans and call loans to the stock market, that were suddenly worth far less than what the banks had paid. When depositors began to question whether their institution could meet withdrawal demands, withdrawals accelerated. Banks that could not meet those demands failed, and because deposit insurance did not exist yet, those failures wiped out the savings of millions of Americans completely. The government's eventual response included two things that matter for today. First, the creation of the Federal Deposit Insurance Corporation in 1933, which insured deposits and broke the psychological cycle that made bank runs self-fulfilling. Second, and this is the piece that almost no one connects to the banking crisis, Executive Order 6102, signed by Franklin Roosevelt in April 1933. That order required U.S. citizens to surrender their gold to the Federal Reserve at a fixed price of $20.67 per ounce. Once the government had centralized the gold supply, it revalued gold to $35 per ounce, an effective devaluation of the dollar by 41% overnight. The lesson here is not that the government is about to confiscate gold. The lesson is that in a systemic crisis, governments use the tools available to them to stabilize the financial system, and they do not always ask permission first. The 1930s were not characterized by advance warnings. They were characterized by emergency orders that changed the rules after the crisis had already started. Fast forward to the 1970s and the parallel becomes even more instructive. After Nixon closed the gold window in August 1971, removing the last link between the dollar and hard money, the United States entered a decade of monetary instability that modern investors have largely forgotten. Inflation peaked at 14.8% in March 1980. The 10-year Treasury yield hit 15.8% that same year. The Dow Jones Industrial Average, adjusted for inflation, lost roughly half its real value between 1966 and 1982. Bonds were catastrophic. A 30-year Treasury bought in 1970 delivered returns that, in real terms after inflation, were deeply negative for most of the following decade. And through all of that, the depositors who kept substantial cash balances in savings accounts watched the purchasing power of those balances erode year after year, while the nominal number on their statement stayed the same or grew modestly. That is financial repression, and it is not ancient history. It is the policy template that central banks default to when debt levels make other options politically impossible. During that same decade, gold moved from $35 an ounce in 1971 to over $800 by January 1980. Silver went from approximately $1.50 in 1971 to nearly $50 by the same peak. These were not speculative moves. They were the mathematical consequence of investors rotating out of depreciating fiat-denominated assets into scarce stores of value that could not be printed or diluted. The investors who understood that the monetary system itself was being reset were the ones who came through the decade with their purchasing power intact. Now bring this back to February 2026. The current debt trajectory in the United States is not a future problem. It is a present condition with immediate policy implications. Total federal debt stands above $36 trillion. The Congressional Budget Office projects interest payments on that debt to exceed $1 trillion annually for the foreseeable future, more than the defense budget. At the same time, the Federal Reserve has a balance sheet that expanded from roughly $4 trillion before COVID to a peak of nearly $9 trillion and has been slowly normalizing through quantitative tightening. That process of normalization, of removing excess liquidity from the system, is part of what created the conditions that made the BTFP necessary in the first place, and now the BTFP is gone. Here's where the ATM cap becomes the exact right frame for understanding the current risk. Banks set ATM withdrawal limits for two stated reasons. First, to manage physical cash availability. ATMs hold a finite amount of currency, and banks maintain limited cash reserves. Second, to protect against fraud. A cap limits the damage if a card is compromised. Those reasons are real, but the cap also functions as an implicit liquidity management tool. In a stress scenario, the speed at which a bank can experience deposit outflows is a function of how easily depositors can access their money. In the pre-digital era, bank runs required physical presence. You had to show up at a branch and wait. That friction created natural speed limits. Today, digital banking allows instantaneous transfers. The SVB collapse demonstrated that depositors submitted $42 billion in withdrawal requests in a single business day. The only frictions that remain are the ones banks choose to impose, including ATM caps. The systemic risk exception invoked by the Treasury Secretary in March 2023 allowed the FDIC to protect all deposits at SVB and Signature Bank, including uninsured deposits above the $250,000 limit without pre-authorization from Congress. That decision was made in a weekend. It was not guaranteed by law. It required a determination that systemic risk justified it. The GAO reviewed that decision and concluded it likely helped prevent further financial instability. But what that review also confirmed is that the protection of uninsured deposits is not automatic. It is conditional. It requires a specific determination by specific officials under specific circumstances. If those circumstances are not met, uninsured deposits go into the standard resolution process, and recoveries can be partial. According to FDIC data, roughly 40% of domestic deposits in the U.S. banking system are uninsured, meaning they sit above the $250,000 insurance limit. That percentage is highest in institutions with concentrated commercial customer bases, tech sector exposure, and real estate-adjacent business activity. The same profile that showed up in every institution that experienced acute stress in 2023. What the BTFP essentially did was give those institutions a bridge, a way to access liquidity without forcing asset sales that would crystallize losses and trigger confidence crises. That bridge is now gone. And here's the specific dynamic that makes the current moment distinct from the period immediately after the BTFP was created. In March 2023, there was an emergency response apparatus assembled in real time. The Fed, the FDIC, and the Treasury coordinated over a weekend to deploy a program that did not exist on Friday and was fully operational by Monday. That response capacity exists, but it is not prepositioned. It requires a trigger. It requires a failure or a credible imminent failure to activate. And between that trigger and the response, there is a window. And during that window, the people who understand the mechanism are the ones who act. The FDIC estimated in 2024 that providing blanket coverage for all deposits as a standing policy rather than an emergency exception would require increasing the deposit insurance fund by at least 70% from its then current level of $129.2 billion. That increase has not happened. The fund financed by bank premiums grows slowly. What that means practically is that the safety net for uninsured deposits remains what it has always been: contingent, discretionary, and dependent on a systemic risk determination that is made after the problem has already developed. There is a third layer to this that most people never look at, and it connects the ATM cap story to something much larger than any individual bank. It is about what happens when a policy framework that was built to contain a 2008-style crisis interacts with a speed of information transmission that did not exist in 2008. The FDIC's standard resolution process for a failing bank has always assumed a certain amount of time to conduct due diligence, time to find an acquirer, time to communicate with depositors. That assumed timeline was built around the physical reality of banking in previous decades. You could not move $42 billion in one day because the infrastructure for doing so did not exist. Today it does. And what SVB demonstrated is that the speed of a modern bank run has now outpaced the speed of traditional resolution mechanisms. The regulators know this. It is documented in the Federal Reserve's own post-mortem analysis of the 2023 events. The report noted specifically that social media amplified information flows and the instant accessibility of digital banking fundamentally compressed the timeline from depositor concern to institution failure. What that compression means is that the window for orderly intervention is shorter than it has ever been, and the window for you as a depositor to make decisions about your own exposure is also shorter. In the period before digital banking, a depositor who became concerned about their institution had days to assess the situation, to speak with their bank, to make decisions. That information lag created time for regulators to act first. Today, that lag is effectively zero. The information that moves markets and triggers withdrawals travels on the same infrastructure as the withdrawals themselves. And the withdrawal caps, the ATM limits, the daily transaction ceilings, are not keeping pace with that speed asymmetry. Consider what happened between the close of business on Thursday, March 9, 2023, and the FDIC's seizure of Silicon Valley Bank on the morning of Friday, March 10th. In that roughly 18-hour window, $42 billion in withdrawal requests were filed. An additional $100 billion was queued for the following Monday morning. The total uninsured deposit base of SVB was approximately $151 billion. The bank's entire equity buffer was approximately $16 billion. The math does not close. There was never going to be a path through that without either a complete government backstop of uninsured deposits or a catastrophic loss for depositors above the insured threshold. And the decision to backstop those deposits was made under enormous time pressure over a weekend by a small group of officials with no congressional authorization and no advance policy framework specifically governing that outcome. What the GAO report published in January 2025 confirmed is that this kind of emergency determination, this invocation of the systemic risk exception, is not something that can be reliably assumed in advance. It requires a specific set of conditions, a specific set of recommendations from the FDIC and the Federal Reserve, and a specific determination by the Treasury Secretary that systemic risk justifies overriding the standard loss allocation hierarchy that would normally see uninsured depositors take haircuts. The political environment in which that decision is made matters. The fiscal constraints of the moment matter. The composition of the relevant agencies matters. None of those things are constants. What this means for February 2026 is that the safety net is exactly as thick as it was before March 2023, which is to say it is a standard deposit insurance fund that covers up to $250,000 and a conditional emergency authority that may or may not be invoked depending on circumstances that cannot be known in advance. The BTFP created a perception of additional security that no longer exists, and the institutions that benefited most from that program, those with the heaviest unrealized loss positions and the most concentrated uninsured deposit bases, are now operating in an environment where their primary liquidity backstop is the discount window, a facility that carries stigma and that institutions have historically been reluctant to use because the act of using it signals distress, which can itself accelerate the very withdrawal behavior they are trying to prevent. The Federal Reserve is aware of this dynamic. There has been regulatory effort to make the discount window less stigmatizing, to encourage banks to preposition collateral and treat it as a normal liquidity tool rather than an emergency last resort. But the stigma is structural. It is baked into the way credit analysts, rating agencies, and sophisticated depositors interpret the signal of discount window usage. And as long as that stigma exists, the facility is only fully available after the crisis is already visible, which is precisely the moment when it is least helpful for the depositors who need to make decisions. Now, what are the three positions that make sense in this environment? Not emotionally, not as a reaction to fear, but as a rational response to the specific conditions I have just laid out. The first is understanding your actual exposure. Go through every account you hold and calculate your uninsured deposit balance, the amount above $250,000 at any single institution. If that number is above zero and you have not structured your holdings to account for the conditional nature of that protection, you are carrying a risk you may not have priced. The remedies are straightforward: spreading deposits across multiple institutions so that each balance stays at or below the insured limit. Using reciprocal deposit programs, which the FDIC has allowed since 2018, that effectively extend insurance coverage across a network of participating banks, or converting a portion of liquid cash holdings into assets that exist outside the deposit system entirely. The second position is physical precious metals as the systemic hedge that requires no counterparty to perform. Gold and silver are not investments in the conventional sense. They do not generate income. They do not have earnings reports. They exist as a store of value that carries no issuer risk, no custodian risk in their physical form, and no exposure to the balance sheet mechanics I have described. In every period of monetary stress in modern history, the 1930s, the 1970s, 2008, 2020, physical precious metals preserved purchasing power while paper assets repriced. Gold is currently near all-time nominal highs, but adjusted for the cumulative inflation since 1980, it is still below its real peak from that year. Silver, with the gold-to-silver ratio still elevated relative to its historical average near 50.1, reflects an asset that is not yet fully priced in the monetary dynamics that are driving gold higher. The asymmetry is meaningful. Physical metal held outside the banking system is not a liability on any institution's balance sheet. It cannot be bailed in. It cannot be diluted. And it is not conditional on anyone else's solvency. The third position is reducing duration risk in fixed income holdings. The term premium, the extra yield investors demand for holding longer-dated bonds rather than rolling short-term paper, has been rising. When inflation expectations are uncertain and central bank credibility is contested, long-duration bonds are not the safe haven they are marketed as. They are the asset class that destroyed purchasing power for a decade in the 1970s, and the asset class that produced massive unrealized losses for banks between 2020 and 2023 as rates rose. Shorter duration instruments, inflation-linked securities, and real assets with direct exposure to commodity prices are the alternative side of that trade. Let me be precise about what is known and what is not. What is known is that the BTFP closed in March 2025. What is known is that the liquidity stress ratio at U.S. banks remained elevated above pre-pandemic levels through late 2025 based on Federal Reserve data. What is known is that uninsured deposit protection above the FDIC limit is conditional and requires a systemic risk determination that is not guaranteed. What is known is that ATM withdrawal caps are discretionary bank policy that can be modified without customer notification. What is not known is when or whether a specific institution reaches the point where these dynamics interact in a way that produces acute stress. The 2023 crisis demonstrated that the timeline from stability to failure can compress to 48 hours. What is also not known is whether the next period of stress will produce the same emergency response coordination that contained 2023, or whether political and fiscal constraints make that response slower or more limited. That uncertainty is precisely the argument for positioning before clarity arrives, because by the time the signal is unambiguous, the option to act has already partially closed. SVB depositors who understood the bank's balance sheet and moved funds in February 2023 had more optionality than those who moved in March. The Cyprus depositors who held assets outside the banking system in early 2013 did not have their savings converted into equity in failing banks that spring. The mechanism in every case is the same. The people who are hurt are the ones who assumed that the system would protect them by default, without understanding the conditions under which that protection activates. The ATM cap is your bank's first line of liquidity defense. It is the physical expression of a policy that exists to manage the bank's cash position, not yours. In a stress environment, it is one of the first levers that tightens. Not with an announcement, not with a warning. It just becomes harder to access what you thought was simply yours. Here's the question I want you to answer in the comments, because the perspective of this community is part of what makes this worth building. What percentage of your current liquid holdings are in uninsured deposits at a single institution? And more importantly, when did you last review that exposure against the structure of the deposit insurance framework? Drop your answer below, because the diversity of where people actually stand on this is something I want to understand, and I think you will find the responses instructive. If this breakdown gave you a framework that changes how you think about the relationship between your bank account and the systemic mechanics underneath it, then I need you to do two things right now. First, subscribe and turn on notifications. The conditions I have laid out in this video are not static. They will develop. The next update to the banking vulnerability data from the Federal Reserve, the next FDIC quarterly banking profile, the next period of market stress that tests whether the institutional memory of 2023 translates into a faster response or a slower one, all of that is material, and you need to be watching it with context. Second, share this with someone who has significant assets in the banking system and has never thought carefully about the difference between an insured and uninsured deposit. That distinction is not complicated, but almost no one who is not actively managing institutional money has been made to understand what it means in practice. The bank run does not start with empty ATMs. It starts with a balance sheet problem that no one can see from the outside, an emergency facility that expires quietly, and a growing gap between what the system owes depositors and what it can deliver without intervention. That sequence is not hypothetical. That sequence already happened once, and the mechanism that temporarily closed it finished unwinding 11 months ago. The question now is not whether you understand the risk. It is whether you are positioned ahead of the next point where that risk becomes visible to everyone at once. I will see you in the next one.